As happened with a bunch of consumer-facing companies, Page Industries too had a quarter, which from the kind of expectations that were the consensus estimates, both on the revenue and the margin front, the delivery was below estimates. But on both the counts, the company in the con call has said that they expect a bit of a clawback. Now, the question is the pace of the clawback. The question is how are consumer trends holding out in a scenario wherein a bunch of companies are saying that rural is looking a tad weak. And what about Page's own assumptions about what could happen in the second half? Mr. K. Chandrasekar joins in right now to talk about that. The beauty about a conversation with Mr. K. Chandrasekar is that we know that the long term is strong enough. What we need to figure out is what could happen in the short term. Mr. Chandrasekar, great having you. Thanks for joining in. Hope all is well.
Thank you. Thank you so much. Hope all of you are doing well. Thanks once again for having me on your channel. We have done quite well. I've been saying that Q1 was the best quarter in the history of Page Industries in FY23. Q2 is the second best and actually the best Q2 in history. We have done quite well. We are satisfied with the 16% growth in revenues. The volumes have been flat. But, last year we had masks, which is not the core business for anyone. So if we look past the impact of masks, we have actually grown 20% revenues and volume by about 7%. The margins, EBITDA margins are about 19% as reported. But again, this is the continuation of our belief in the opportunities before the brand. We are invested in advertisement, digital media this quarter. We have also invested in creating warehouse capacities. We have brought many more people in the past year or so, including this quarter for sales and production. So this is coming from this optimism for not just the long term, but even the short term. As we head into Q3 and Q4, the raw material prices are weaker. So we are, that momentum which you saw in those 2 years of the pandemic is just the same. And Q1 is historically the best quarter in a normal year for Page Industries. Q3 is the festive season. So Q2 comes in between and is not necessarily as strong as Q1 or Q3. But that doesn't stop us from investing in the growth of the Jockey brand in India.
Most certainly. And, I'll come to the growth numbers in a bit because I have a lot of questions there. First, let me tackle the margin picture. Now, the gross margins, you did well in Q2 despite what I thought were inflationary trends, both in cotton and packaging materials. I heard you mention that there has been some price hikes, or maybe I read about it, but I definitely heard you mention that the trends on the input costs have become a bit better in Q3. So what went behind the kind of performance in gross margin? Was it essentially pricing? And how does that therefore behave in Q3 and Q4 when we are seeing a slight deflationary trend in the input costs?
Yeah, again, good question. The gross margins have, if you go back into history of Page Industries, we have always been around 39 to 40%. And that is because we manage the price increase every year so that we land between 20 and 21% EBITDA margins, right? So therefore, the margins are always in the same range. But again, the OPEX varies because of the absorption in different quarters. On a full year basis, we would definitely be delivering much better than 20-21%. And also going forward, yes, the raw material prices are weaker and there will be better absorption if there are better revenues.
Okay. And I also heard you mention that you've invested a lot in digital advertising, I believe in promotional materials, etc. So do you reckon that what you would want to do ideally is maintain the EBITDA margin trends, whatever, circa 2021, or would you believe that if there is an expansion that comes in EBITDA margins, you will take it in your stride?
That has not been the philosophy of the brand. The philosophy of the brand in India is to be an affordable premium player and extremely affordable at an Indian price, as I keep saying. So that is the reason why we sell nearly 240 million pieces of apparel across India and present in 120,000 retail stores and present in most of the geographies. So That construct of the brand, the aspiration of the brand is to fetch around 20 to 21% EBITDA margins. Because of the cotton price increases in the past year and more during the pandemic, we had to raise prices twice. Last year, about 5% in Q1, about 8% in Q3. And again, in this Q1, it is about 3.6%. So we have done these price increases, but if the raw material prices are stabilizing and reversing, there would be no need to increase the prices by very much. Before the pandemic, we only did about one price increase in a year, around 3 to 4%, to get us back to the EBITDA margins. So we're quite satisfied. We are not looking for improving the margins beyond 21%.
No, what I meant was, so if there's a fall and a fall is slightly larger than what you would have anticipated, would you kind of spend it in advertising or giving it back to the customer in some fashion? How would you do it? Or would you take that uptick in margins?
50% of the top line, the revenues are raw material. So, typically, if the raw material prices move up by about 10%, we'll have to revise prices upwards by 5%. But then you have other OPEX also, which is about 30% is the other OPEX, 20% is your EBITDA margin. So that also moves, that consists of inflation, additional manpower to fuel the growth, increments, and the OPEX inflation which comes in. So that arithmetic has to fit in. And typically, we would not like to increase the prices to the ultimate consumer. Because as we are getting into more and more tier 1, tier 2, tier 3, tier 4 cities, we would like to be the most affordable premium apparel brand in the product categories in which we are operating. Yeah.
Okay. So I reckon even if the raw material prices go down, you don't foresee a sharp uptick in margins, if anything.
It will get adjusted in the price.
Adjusted prices. Perfect. Okay. Now let's talk about demand, Mr. Chandrasekar. I read with interest, and I'll read out that comment from a note that you've mentioned on the call that you are witnessing premiumization in most parts of your portfolio as you are rapidly expanding into smaller towns with a better product assortment targeted to rural and smaller towns. Now, if that is indeed so, I would want to understand from you, what is your experience and anticipation of rural demand? Because every single company that we've spoken in the consumer space is telling that rural is looking weak, whereas urban is looking strong. What is your experience? What is your expectation?
We have a lot of, I would say, pent-up demand for the Jockey brand. We're not like rural. We're looking at tier 3, tier 4.
Tier 3, tier 4.
Yeah, so we're not like a brand with a huge rural presence to be able to comment on that. But at the same time, speaking from our own experience, the demand for the Jockey product, there are distributors, there are channel partners waiting to have Jockey in their store. So my information and understanding is that the throughput in all these new outlets, retail outlets, is almost the same as you would expect in any other town or city. So we have grown consistently. We have grown, and even as I said, 20% growth this quarter. So we have not felt that that the demand is weakening in the true sense. There may be a month or two, one of the quarters may appear to be below expectation of the market. But from the business ground upwards, we are continuing to add channels. So you have seen that we almost added about 4,000 plus retail outlets, in this quarter alone. And close to about 7,500 MBOs have been added in H1. Similarly, the EBOs have also grown. The footprint of the Jockey brand is ever expanding. So we retain that long-term outlook, investing in the brand and being an affordable premium player, and continue to keep growing.
Okay, and I guess which is why in the near term about maybe 15 to 20,000 MBOs and if I'm not wrong, 150 or 175 EBOs.
Yeah, yeah, we are close to about 1,200 EBOs, and we have added almost about 50 in about 60 in the first half of this year, and we are now present in about 400 and 8 cities to be exact. So the growth is a continuous momentum of the brand. So, and then the reason why we do this kind of, I mean, you know that we have grown almost double in about 2-3 years. So the reason is because of the demand that exists for the brand.
Yeah, sure. Actually, which is where my questions come in, Mr. Chandrasekar. The question is not about whether page will grow or no. Grow you will, because you've told us 2-3 times in the past interviews as well about the extent of the opportunity available. The question is only about how will you grow. So I have two questions on this. One, we've seen you expand in areas like Dubai. I presume that is where the premiumization would be at its peak. At the same time, we are seeing you expand your portfolios or the reach in tier 3, tier 4 as well, if not rural. There is an attempt to premiumize there. I'm guessing the price point, the sale points, and the margins would be different at different segments. How do you reckon you would want to grow over the course of the next 2 or 3 years, in terms of not just the volumes, but the, for lack of a better word, the margin, the premiumization element that comes into this growth?
There will be a definite premiumization, which means that your average selling price, ASP as we call it, will keep moving up in the value chain, because there are more and more consumers who are used to the brand, who want to try some of the premium products at the upper end of the range in all the product categories that we offer. This premiumization does not immediately mean that they are better margins, because when we price it, we ensure that typically we pitch around this 20-21% EBITDA margin as a weighted average in each of the product categories. Some are more, some are less. But I'm saying on the whole, empirically, we are happy with this kind of margin. So premiumization means that there are more products and styles within a product category. For example, the men's athleisure and so on. So the premiumization in this quarter is about 6%. So we have gone to Dubai, yes, and because we are franchised for the whole of India, the neighboring South Asia countries, and the Middle East. So we have sort of shared this information on a press release, but at the same time, we have been quietly also opening stores in other Middle Eastern countries, and the pace is only accelerating. Regardless, the volumes that you would get out of the Middle East or any other South Asian neighbor will be very, very small compared to what we can get in India, and the potential of the opportunity is much bigger in India.
Yeah, sure. So, okay. So the reason of this expansion is more a geographical diversification or making the brand presence felt? Or do you reckon that in a few years' time, 2, 3, 4 years' time, the overseas contribution could become meaningful?
The aim is that the contribution from the overseas markets have to become more and more meaningful, and to be able to do justice to the reach of the brand in the other countries as well. So, Sri Lanka was going through a tough time, and similarly some of the other neighboring countries like Nepal and Bangladesh. So we have now reinforced that kind of commitment to grow post the pandemic in all the overseas markets. And it is, I mean, as far as the Jockey brand and Page is concerned, it is not one at the cost of the other, because we have now people who specialize at country level only on certain product categories. There are country heads in India, and there is a head of export who is now focusing. Earlier, we had a lot of this happening from within a unified sales organization. Now there are specialists who understand the markets well, who invest more time. The more time so we invest in those markets, I'm sure we will be able to harness the potential better.
What would be a number that would please you 3 years out, contribution from overseas markets?
It is hard to take a call. I mean, if I were to guess,
what would please you?
It would, I mean, I mean, nothing would. I mean, there is no upper cap on aspiration for the
I'm
for the
talking about the
brand.
lower cap.
Yeah, I mean, so I would say, somewhere in the range of 3%.
Oh, okay. So not
Yeah,
meaningful. Okay, fair call.
revenues will make it meaningful for the effort.
Okay, okay. So it's to that extent. Last couple of questions. I read with interest the conversations that you've given on the call about how you believe both on the operational metrics front as well as on the revenue front as well. You expect a clawback to near normalcy, if not in Q3 and Q4. And please correct me if I'm wrong here. Do you reckon it'll happen in Q3 itself, or do you reckon a near normal picture could go out in Q4, both on the sales front as well as on the margin front, more importantly?
I think the definition of a clawback, or for that matter, even a normalcy, is, I think, not the correct way to represent the results, because we know clearly in advance that we are going to invest regardless of the quarter to quarter revenue growth. We are going to invest in advertisement. We are going to create the capacities, because therein lies the growth of the brand. Right? So I think the 19%, we would have still hit 21% margins if we had not invested in the future in terms of advertisement and people and warehouse capacity. So that momentum of investment to grow the brand in a healthy way continues, and Q2 is no exception. So sometimes we are okay to get margins lower than 20% in one of the quarters.
Sure, get your point.
So I think there is, I mean, we are, I would say, better than normal. In as we, even, I mean, pandemic is well and truly behind us. So we have been bettering each quarter upon quarter, and this is the best Q2 in history. So as I told you, we would obviously want to do more, but we are quite satisfied with Q2.
No, okay. My final question or final two questions, Mr. Chandrasekar. Your guidance stays, while your core volume growth may have slowed down to 7%. I'm sure the street believes it will go back. Where I just wanted some clarity on is that different notes are estimating different things on how would you reach that number, because of the kind of investments that you will have to do or are doing in order to grow. So therefore, would it be safe to assume that on an annualized basis by FY26, when you reach that targeted guidance of $1 billion sales, you would still on an annualized basis consistently be in that range of 20-21% EBITDA margin?
Margins are never the concern. We are focused on the volume and growth of the brand. How do we reach all the potential markets and consumers for the brand? Margins have never been a concern historically through for Jockey and Page Industries. So it will be on a weighted average. We have always delivered better than 21% margins, and that will continue this year as well.
Okay. Well, few analysts have gotten it wrong, a few have gotten it right. I'm glad you clarified it on our platform. Mr. Chandrasekar, last question. What about product categories? You've launched some fairly successful product categories in the last 3 odd years. What's on the anvil?
We have the whole range of the product categories we want to be present in. Like men's innerwear, women's innerwear, athleisure, men, women, socks, thermals, towels, and so on. Only the masks are dropping off, and fortunately so this year. We have new launches all the time. If you look at this quarter's publication, you will find a lot of these sweatshirts and thermals and jackets, which are topical for the season we are in, have been there. So within the product categories, there is a deepening of the range, refreshing the range, the product category, and so that it is trendy and appealing to the consumer class. So there is beyond the masks and the caps and handkerchiefs and socks and thermals and towels and so on. And there is not many more categories that we can. We are present in everything that we want to be present in.
Got it. Okay. Well, we'd love to understand how Q3 goes once those raw material price pressures are weaned off. So we'll love to talk to you around your Q3 numbers release. But for that and the quarters ahead, thank you. All the best, and thank you so much for speaking to us today.
Thank you so much. Yeah. Have a good day.
Yep. You too, and viewers, thanks for tuning in.